All right. Good morning once again. Yes, we do apologize for that technical hitch. I mean, this is the nature of any live broadcast. Sometimes equipments just decide to do that thing, and technology isn't something that we have to take lightly, and we have to adapt and move on. So welcome back to this conversation. This is a webinar conversation courtesy of GT Bank Kenya. Now, what we're looking at today, as I had earlier mentioned, is sustainable growth for SMEs. If you're just joining us in this conversation, this is a conversation that we're trying to look at where we are right now in terms of what are some of the key things that are happening at the macroeconomic level, what are some of the things that are happening globally, and how then do we fit in and how do we prepare our businesses going forward. We're looking at sustainable growth for SMEs, the role of governance in protecting profit, reducing risk, and attracting capital. How does governance relate to your ability to be able to access capital? What are some of the things that you need to understand for you to know that my business will be able to get funding and at the right risk assessment? So I'm in the company of Miss Madren Oluot, who is the managing partner at Azali, a company secretarial and corporate governance practice. I mean, they have been doing this for quite a while. She personally tells me that she's been in the game for nearly 2 decades, slightly over 2 decades, because she's been around for about 25 years. So definitely, she is the right person to take us through this and to help us understand what do we need to do, what are some of the common mistakes that we make in our businesses. Stay tuned. And remember, you can share all the questions that you might have. If you have a feedback, if you have a comment, we're live on LinkedIn. We're live on, we're taking feedback from LinkedIn, all our social media platforms at GT Bank Kenya. But you can stream this conversation on Zoom as well as YouTube. In case you have a problem, let's say with your YouTube, go to Zoom. In case your Zoom is acting up, you can follow the conversation on LinkedIn, on YouTube as well, and on Zoom. So use the two platforms to be able to engage with us. Send in your questions on the chat if you're following this conversation on Zoom. If you're on YouTube, just go to the comment section and you can just tell us your name and go ahead to fill in your question or comment, and we'll be sure to sample some of them as we go along with this conversation. At this point, ladies and gentlemen, allow me to welcome Ms. Madren to take us through what the scene looks like, to set the stage for us, and then we'll be getting into that conversation. Madren?
Thank you, Jimmy. It's great to be here engaging on this very, very important topic of sustainable growth for SMEs. As an SME business owner myself, having run my professional services practice for the last 10 years, I really want to be able to engage with our audience to see where we can assist to unlock growth, but not just growth, sustainable growth, just for now as well as for the future. So in terms of statistics, we have had very many surveys that have been done in our market in Kenya on SMEs and MSMEs as well. And what these studies show is that a lot of our businesses, our SMEs, are actually growing. They are very, very viable. In fact, around 77% of them have an annual turnover of over 10 million, which is quite substantial and a great contributor to our Kenyan economy. Of those, 63% are profitable. And so the question then for us to consider is how do we manage to protect that profit and build wealth for the long term? And how can we also be able to take advantage of some of the credit facilities, the financing opportunities and investments that are available in our market to grow our businesses? So as we move into this topic, I would also want us to consider what are some of the issues that we have in terms of sustainable growth in our SMEs. I think from where I'm sitting and having worked with very, very many different sector players, different sizes of companies, what is actually stopping us from scaling up and doing so in a manner that can move from generation to generation is the lack of governance structures and accountability. So for us to be able then to protect profits, to think about reducing risk in our businesses, as well as to be able to attract capital, we have to deal with the question of governance. As part of the survey, what came out was that a lot of SME owners and management believe that governance is expensive. About 38% of them say that governance is expensive. and about 27 of them cite a lack of awareness about the need for governance structures. So you run a business, but sometimes you're very focused on the ambition, you're focused on, the hustle, but you have to remember that for that to continue, for you to be able to scale up, you have to think about structures to safeguard that wealth that you're creating. So our role here this morning, Jimmy, isn't for me to suggest a lot of complexity or bureaucracy. And hardly that. All I want to position to our audience is the need for clarity, the need to have a rhythm in how you're running the business, and also to provide evidence that can be used if you're looking for funding, or if you're even looking for someone to come and invest in your business, or even to sell or to list on the stock market. So that is what my recommendation would be to our SME practitioners. In terms of governance, the minimal governance structure that we would suggest that business owners consider setting up is to separate 3 key players within that organization. We have the owners of the business, who in legal terms would be called shareholders or members. And they basically are the ones who have the purpose, they bring the vision, and they're the ones who set the long-term, agenda for what they expect the business to deliver. And they bring in capital and resources. They hand that over to a second group of people called the board. We might not have a legal board. Your company might not have gotten to that point of governance yet, but there could be advisors who are informally structured so that they're able to then come in and support you in terms of thinking through your strategy, holding you accountable, and helping you to think broadly about how to run the business and take advantage of what's happening in the market. And then the third group of people are the management. These are the people who are in the day-to-day running of the organization. They wake up in the morning thinking about the company and the operations and how to report results. So as a minimum, we would suggest that organizations and SMEs start to think about structuring their business in that way, having 3 different organs that have clear authority and a rhythm that allows them then to move through the business cycle. I would also suggest that for us, as we think about embracing this and protecting profit and reducing risk, there are 6 practical moves that we can take as business owners and as senior management leading these organizations. To protect profit, one must think about strategy and oversight. How do you ensure that your priorities, your goals for the organization for the next year, for the next 3 to 5 years are clear? Are those reviewed on a regular basis? Are there risks that are coming from around the corner? And then the second element is to provide that clarity. Who has the decision-making power? What are the checks and balances within the organization? Hence the need for that board management and shareholder structure. And then thirdly, to protect your profits, you need to think about risks. Risks come at us from everywhere, and there are many types of risks. Most recently, we saw the one that affected us as a world, COVID. But beyond those ones, which are considered black swans, they happen once in a lifetime. There are daily risks that are there in your operations, in your company. There are strategic risks, there are economic risks. So as you run your business, you have to be mindful of the macro economic environment, but also thinking about from within, how do I protect the cash? Is there any wastage? Is there any leakage? Are there internal controls within the organization that allow the company to scale? Do we have audits? Do we keep books of accounts? And are we complying with the laws and the regulations that are around that company? So those would be the 3 steps, 3 practical moves to think about when you're thinking of protecting profit: strategy, clarity of role, and also controlling your risks. When we move across to thinking about reducing risk and building trust, what I would suggest is 3 things. Entrepreneurs need to think about financial discipline. A lot of times we mix our personal expenses with the business expenses. We don't keep proper books of accounts. We don't have regular audits. We don't even have budgets. So having that discipline is important in terms of helping to provide accountability and even to communicate to your employees what is expected of them. Next would be the issue of ethics and conflicts.
Yeah.
As the business is growing, what tends to happen is there are many more players, there are many more stakeholders in the environment that then bring in their interest and their concerns. So having a very simple understanding of what is acceptable in my business, how will I run it? Am I a business that is grounded on integrity, or do I do business taking shortcuts? Being very clear with your staff, being very clear as a business owner, what is acceptable behavior, and where there are breaches in behavior, what then tends to happen. That communicates a lot, particularly to external stakeholders. And then last but not least is thinking about your stakeholders, both within, such as your employees, but also external stakeholders, such as your shareholders and even your funders, if you have any. So those would be my last 3 practical moves for our audience to be thinking about: financial discipline, ethics and conflicts, as well as stakeholder communication.
All right, thank you very much, Madrin. And I'm actually just taking notes based on what you're saying, because I want to take you back to this conversation at the very foundational level. One of the things that tends to happen is you will find that a lot of SMEs are owner-run businesses, in the sense that every decision that has to be made about the company, about the future of the company, about the investment, and whether we have the capital. I am the HR, I am the board chair, I am the CEO. So what is the risk in doing that?
You create a bottleneck. What tends to happen is, as a founder, as the owner of the business, if everything is resting upon your shoulders, then you start to slow down decision making, because people are then looking to you. Has the boss agreed? Have they approved? And then you take on more risk than you really should be taking on, because now you're running the organization end to end, and that can slow down your growth and your scaling up. So as a founder, as a business owner, you have to take time to sit back and ask, why did I start this business? Where do I want it to go? And what is my role in this future? And allowing yourself to be surrounded by people, professionals, experts who can help you to grow the business beyond your own capability. So your role as a founder, keep the vision alive, ensure that the dream is being fulfilled, but at the same time have advisors, have a management team, deploy talent. Great. Kenya is so blessed in terms of its people resource. People who are highly educated, ambitious, innovative. Leverage that so that you release yourself to be able to think about, the forward-looking, create new business ventures, and be able to secure your wealth and your health for the long term.
All right, and just to remind our audience who are following this conversation, both on Zoom and on YouTube, that this conversation is largely about you. And so we want to hear from you. Send in all your questions. If you're an SME, what are some of the challenges that you are currently dealing with? And we'll be forwarding those questions to Madrin to be able to help you understand how then you move from one level to another. Remember, the handles to use is GT Bank Kenya across all the platforms. That is where you can send in your questions, whether it's on LinkedIn, whether it's on YouTube, on X. The hashtag to use is banking with ease. The hashtag we're using for this conversation this morning is banking with ease. And Madrin, so you've talked about setting up your practice for about 10 years. And the thing that I want you to help me understand, and I'm sure it will also help those that are following this conversation, is during the initial and the formative stages of the business, what are some of the issues that you were dealing with at that time that then you were able to overcome? And especially during the first 3 years, to the first 1 to 3 years are normally the most critical for any business. In Kenya, we are told businesses die within the first 3 years. But from the data that you've just shared with us this morning, we're talking about 77% of SMEs having about a turnover of 10 million and about 63% of them being profitable. So I want you to look back at your practice, and during those formative years, what are some of the things that you struggled with and how did you address them?
Thank you, Jimmy. Yeah, at the beginning of running the business, one of the things that I struggled with was just appreciating how to position my product and my services and to price it. Because at some point, you are trying to meet a need that is in the market. So first of all, determine whether or not there is a need in the market. Are there people who are willing to pay for your service? Is there a gap in the market that you can plug into? So my challenge was around positioning of my customized services and pricing, because you're new to the market, people don't quite understand, and therefore that conversation then becomes very, very important, so that you don't underprice, but also you don't overprice and therefore lose a potential customer. The other thing that I also struggled with at the beginning was the element of people and finding the right people. It is very, very easy to hire people into the business, but finding the right hire, the right capability, the right culture and values is very, very difficult.
It's critical, yeah.
It is an expensive process. If you hire people and then at some point you realize I need to separate with this individual because they are not productive, they are not adding value, or their integrity system and value system is different. Yeah.
All right, so let's talk about the viability of SMEs today. I mean, volatility has become the most common thing that we're seeing in different markets, whether we're talking about the Kenyan market, whether we're talking at what is happening globally. There's a sense that volatility, it has become the constant in this era that we're living in. So for someone who's still trying to set up a business and you're struggling to survive, how do you balance that mix of ensuring that you meet your basic needs, but at the same time, you put the right structures in place?
Yeah. Running a business is challenging in this economic environment, and not just in Kenya, but even globally. You can see all the changes that are happening in our market as a result of activities outside of Kenya. Supply chain is being disrupted, markets are changing. So if you're a business owner, I think what you should do is to accept that change is constant. The environment is going to continue being very fluid, it's going to be very volatile, and so you need to be agile in terms of anticipating potential risks, but also identify trends, because sometimes in that environment there are opportunities. So think more about opportunities and mitigate the challenges that are likely to come as a result of the volatility in your business environment.
All right, so let's talk about the structure of the business. And this structure, in the sense that you've talked to us about the three arms, and this is, you have the management team, and you also have the board and the advisors. And for someone who has a business, the first thing that comes to mind, and you rightfully said this, is that this is going to cost me a lot more. If I'm going to pay Madren to sit on my board and to give me solid advice, I'm going to have to pay for that time. As a small business, as an SME, I don't have that excess capital to be able to invest in that. So how then do I balance the results of having this board in place, the checks that they bring, as well as ensuring that much as I'm investing in them, this is how do I change my perception to viewing it as an investment as opposed to an expenditure cost?
Okay, thank you. That's a very good question, and one that we hear business owners asking a lot. Is it a cost? Is it an investment?
Yeah.
And the way I look at it is to think about what would happen if you didn't have good governance. If you didn't have good governance in your organization, the risks are that no one will want to touch you. Your reputation could be in question, because what will tend to happen is there might be scandals, your profit is not, is a bit checkered up and down. So the converse is also true in terms of helping you to position yourself. So you need to think about, if I don't have good governance, is there going to be a tomorrow for this organization? And therefore think about it more as a long-term play, and that you're seeking to invest. Secondly, talk to the professional advisors who are available, and even these advisors who want to sit on your board or who you're considering to have on your board. There are people who are willing to do this for minimal pay, because for them there are other motivations. They might be wanting to give back to society. They might be wanting to assist SMEs to grow. So they might be differently motivated other than for the cash benefits. So there are players in the market who are available to assist corporates. And we can package services in a manner that is then affordable for you, depending on what solution you need at your level of, and your size, your complexity, and level of maturity.
All right, so as a business, when I'm thinking about my board members, number one, what should I look at in terms of what credential do they bring on the table? And number two, how big or how small should this board be?
Thank you. Yeah. The size of the board really is very much dependent on the size of the company. So, for example, if your company is having about 10 to 20 employees and maybe 3 senior management, you don't want a top-heavy board of 7 or 8 people. That's too heavy for the organization, and it creates an administrative and financial burden. So you look at the size of the organization and then determine then what level of advisory support do you need at the senior most level. You can start off with a board of 3. There's nothing wrong with that. And you will look at your constituent documents to see if there's any maximum allowable. And as you grow, you can then beef that up. In terms of qualifications or credentials for board members, what I would suggest is the question of independence. Business owners tend to recruit their friends and their family members into the board. And that means then there's not sufficient challenge in the boardroom. The right questions are not being asked. It is assumed that the founder is, doing the do and getting everything right. And that's not what we want. We want an engagement that is respectful, that is clear, and that holds everyone accountable to delivering value in the long term for that organization.
All right. Allow me to play devil's advocate and to speak for the business owners. But the one thing that I'm sure a lot of them might struggle with is having Madrin on the board, who then every time I want to make an investment, Madrin will come and poke holes into that investment. So how then do we balance this advice and future plans for the company? Because is the board there to govern and to sort of become that speed governor that ensures that every decision that I make is counter-checked, or is the board there to help me grow?
Right. The board is there to help you grow. So what they do, they will help you to put in place policies, structures, and capital investment plans that you then work towards achieving. The board is not meant to act as a brake. They are there to ask you the right questions so that they challenge your thinking and give you a different perspective. You might be thinking about investment in one particular line, but because of their networks, their experience serving elsewhere, they might ask you to think about new areas of financing and capital raising. So their role there is to be able to provide you with diversity in terms of ideas, opinions, to ask you the right questions, make you a bit uncomfortable. Healthy tension is always good in the boardroom because at the end of the day, then you make an informed decision having looked at all facets of the problem.
All right, so at what point then should I introduce a board to my company? Is it 1 year after being in operation? Is it before getting into operation? Is it 5 years into operation? Is it when I break even?
There's no there's no one size fits all for each organization. So you need to establish whether the organization is at the right level of maturity to be able now to attract and encourage advisors to come in. We would say that organizations that are in the 2 to 3 year phase should be thinking about an informal panel of advisors, board advisors, that the founder can bounce off ideas and just check against. And then with time, as the organization starts to mature and there's complexity of operations, then that can then morph into a statutory board, a board that is registered at the company's act, at the company's registry.
All right, so, and while still thinking about this board, Madrin, and that's why I started by asking you, in terms of competence, do I need board members who have been in the industry that I'm trying to get into, or do I need board members that come from a completely different industry? For instance, if let's say I'm in legal, do I need a board member who's also in legal or a board member who's in finance? If I'm in infrastructure, do I need a board member who's an engineer, or do I need a board member who understands how to sell and market the company?
Yeah, so in addition to independence, diversity is very important. Diversity of skills, diversity of knowledge, experience, age, gender, that helps to enrich the thinking in the boardroom. If, for example, I was a hospital owner, running a hospital, I think it would be short-sighted of you to invite board advisors or board members who are fellow doctors, because then you're all thinking the same way, and you're operating at that limited level. So you need to be able to bring other players who can help you with the general management of the the organization. So as you mentioned, sales, marketing, human resources, legal, and that is guided by your strategy. So if you have a strategy, look at it and ask, who do I need on my board, or what skill set, what profile of person who can open doors, who can help me to access networks, should I bring onto my board?
All right, and just a quick reminder for those that are following this conversation online, that at the end of this conversation, we will have the full video on our different platforms, and you can go back and follow and listen to this conversation. But before we get to that point, allow me to once again remind you and to reiterate that if you have any questions, this conversation is here for you, particularly to address some of the challenges that you may have, to answer all the questions that you may have. So do not hesitate. Go on the chat, send in your questions. If you're following the conversation on YouTube as well, just go on the comment section, leave your questions there, and we will be sampling some of them as we continue with this conversation. Now, Madrid, I want you to, let's bring it home. Mm-hmm. The essence of any business is to make profit. Mm-hmm. The essence of having a board, ideally, is to help me manage the business and to help make sure that whatever decision I make is well thought out. It does not put me at risk. Mm-hmm. Now, fast forward, I've set up my business. I have a board in place. The business is doing fairly okay financially. Mm-hmm. Now, does this governance have a direct impact to my profitability?
Most well-run organizations, well-governed organizations, well-led organizations will translate into results and performance. Mm-hmm. You will see that there's research that has been done that can be able to correlate good governance with a very healthy bottom line. And we've seen corporates in our markets that evidence that. So it is very, very important for us to make that link between having a leadership that is structured, that is clear, that is accountable, and that translates and cascades through the organization into how the organization is performing. So yes.
It has a direct correlation to
yeah.
the profitability
and on the
of the
converse,
yeah.
If there's poor leadership, you will also see that flowing through the organization. There will be an impact in the organization. Performance will stagger. There might be a lag in terms of how you're delivering because you're lacking that ability to move forward and to be directed and held accountable.
Yeah, because in your presentation, one of the things that you talked about is oversight. Mm. And I just want to know, apart from financial leakages, are there other oversights that a board provides to good governance?
Right. Yeah. So oversight is a heavy word, but essentially, if you're thinking about it, just think about it in terms of trees and a forest. Yeah. So the role of the board really is to look at the forest. They're looking at the big picture. They're not in the trees. They're not in the detail. That's for the management team, for those who are in the organization on a day-to-day basis to take care of. And the board is, it comes every so often, preferably every quarter, just to come receive information from the team, ask the right questions, and then make sure that the organization is on track to achieve its business plan or its strategy. So oversight extends across the organization. Financial oversights, are the records, are the numbers that are being presented accurate and reliable? Are there regular audits? So financial oversight over the strategy. Is the strategy still viable? Have things changed in the environment? Do we need to change tact? Are we ahead? Are we behind expectations? Or are we over-exceeding our business expectations? Yeah, so it's across the board. They provide oversight across different parameters in the organization, including people and risk management as well.
All right, and it's interesting that you bring in the aspect of risk management, because one of the questions that I would want you to help us understand, good governance ideally should eliminate or reduce risks. However, risks do happen. So in that case, how does this board, or how do I ensure that my management team then addresses this risk without anyone being blamed for it? Because I'm thinking as an SME and as a business owner, in most cases when things go wrong, my first reaction will be, but I have an entire board of people that I thought to be experts. How did I end up here?
So the role of the board is not to manage risk. Their role is to govern risk. There is a difference between governance of risk and management of risk. Management of risk sits in the business. with the team, because they are the front-facing, they are the touch points with the consumers, with the customers, with the clients. And if you think about it, risk comes in at that level. If, say, for example, you're running an M-Pesa shop and your agent at the desk there is receiving money, there's an element of risk there in terms of that transaction. So risk comes in at various levels of the organization, and that needs to be managed. Typically, risks are managed in 4 ways. You can choose to accept the risk. Perhaps, it's a low risk and low impact on the organization. You can choose to transfer the risk to an insurance company or to a third party. So you take out insurance for various aspects of your business, whether it's your staff, like WIBA. You can take out insurance, medical insurance. You can think about your assets insurance. You can transfer risk in various ways. You can also avoid risk and reduce risk by having policies and internal controls. So you mentioned money. Money is a big one, and you can think about having a cashless system where money is not actually passing through hands. Think about, online platforms to help you be more efficient and also to find audit trails to see how the money is moving within the organization. So there are different ways that you can manage risk and to reduce the risk impact on the organization.
All right, so whenever we talk about risk to SMEs, one of the questions that comes to mind is, when should I introduce internal audits to my business?
Internal audits are useful in terms of providing you with an extra layer of assurance and also defense. As the business is scaling up and growing, you might find that as a business owner, as a senior management, you're not able to be everywhere. And so having an internal auditor coming in with a clear audit plan, I'm going to come and do an audit of the human resource function. Do they have the right policies? Are they recruiting in the right way? What are the, types of separations and terminations? Have they followed the law? That really helps an organization in terms of defending it from risks and also providing assurance that things are being done properly. So I would suggest that business owners start to think about this in the, when the organization has stabilized, it has processes, systems, and is therefore then able to then take on this additional resource to provide assurance.
All right, so the one thing that a lot of businesses, I think, struggle with is setting up these systems and setting up these processes. Why are these processes important? And why is it that if I want to buy this cup, I have to write a requisition, take it to Madren, who will look at it and then approve that requisition, and then I can take it to finance, who will say either we have the money for this or we don't have the money for this. Why are these processes important in a business?
Processes are useful because they provide checks and balances. So, for example, if I wanted to buy laptops for the office, having someone who will go out into the market, first of all, even before going to the market, put together the specifications for what kind of laptop is required, and then go into the market and look at potential vendors and follow a process of shortlisting and getting best value and good quality. Now, these processes are important in terms of helping to safeguard the utilization of the money. So you get best value for your money because you have put in steps and processes and controls that ensure that, someone is not just buying the first laptop that they see, which might be very expensive or it might not be useful for the needs of the company. So processes are there to help provide checks and balances and ensure that there is maximum value that is derived from the investment and the decisions that you're making. Secondly, they also help you with growth, because when, as a founder, as a business owner, you choose to leave or suddenly you depart from this world, because these things do happen, you don't want the business to be crumbling. You don't want the organization to fall apart because you're not there. So structures, processes, systems help you maintain the organization and continue it growing even beyond you. And as you think about your retirement, as you think about your next generation and leaving behind a legacy or even inheritance, structures, systems, processes are very, very important safeguards to protect the wealth that you're building.
So what I'm hearing you to say is that having these structures and processes ensures the business continuity even without the founder.
Yes. it helps the business to be sustainable for the long term. If the founder has set it up right, has brought in people to help run the organization, and it's not dependent on him or her only, then yes, that will help to safeguard and to shore up the organization
All
for
right,
the
so
future.
I have two questions, Madrin, that just come to mind. And one of them is, how often should I have a board, should my board be meeting? Because in most cases, and particularly with entrepreneurs, what tends to happen is I will have a board as Jimmy to come to GT Bank and tell them that I have a proper structure, that I have a well-governed enterprise. However, once the credit is processed, then I discard the board. Or essentially, you have a board on paper, but in reality, the board is ineffective.
Great. That's an excellent question, and one that financiers and funders always struggle with.
Yeah.
So having a paper board, a board in writing on paper is not enough. They need to be meeting. That rhythm I talked about, the consistency of your processes is very important. So typically, good governance would suggest that you do have a board structure that meets every 3 months. On a quarterly basis. So in a year, they will meet about 4 times, and that provides some level of consistency and accountability for the management team. Now, for capital providers of capital such as GT Bank, what they really want to see is they want to get confidence in you as a potential client. They don't want to hear your ideas. Ideas are great, but at the end of the day, you've got to translate them into something.
Yeah.
So provide the evidence for the financiers to be able to invest in you. They need to see clean financials. And when I say clean, I mean reliable, accurate, that you have a timely system in place in terms of providing management accounts, that you have an internal control environment in your organization that allows for risks to be identified and managed, and also that you have transparency in terms of what it is you're doing. There are no other, second lot of books that are being kept under the table.
Yeah.
You are filing your taxes, you are being compliant, and you're also thinking about resilience of the organization and managing any key risks that are in the organization. So they do want to be given the confidence that you are bankable, you are investable. You're not just going to take their money and run and disappear.
So, Madrid, to what extent do you think financial institutions and lenders particularly take into consideration my governance structure in pricing my credit?
It's a very, very important aspect of how they look at your organization. If they are not persuaded that you are running your organization in a manner that is sustainable, then they will price it up. The interest rate that you will be expected to pay will be higher. There will be a few more conditions, and you might not be able to have the room to negotiate as effectively as you would if you were well-led and well-governed and had all the evidence in place. So the board needs to meet, and there has to be evidence of that meeting in the form of minutes, decisions that are documented and followed through. You need to have things like a risk register. You need to have policies. How you managing your financials? Is there a dashboard with key performance indicators? And also, are you thinking about continuity of the organization and the strategy going forward? So capital readiness is a very, very important part of what lenders want to see as they approach you and you approach them for funding.
All right, so let's go to some of the questions that are coming in. We have Shayla Irene, who asks, what governance change or changes, structures should SMEs implement when scaling or expanding?
So in terms of structures, when you're thinking about scaling, what tends to happen is with scale, there's more tension in terms of decision making. It can be at risk. It might be slower, it might be more complicated. You have people in different locations or maybe at different levels. So as you scale, there is more complexity that comes with growth and scaling. So you need to think about structures such as a proper management team that is there to support the business owner and the founders to run the different elements of the business. So having someone who is in charge of finance, finance,
Yeah.
thinking about someone who is in charge of your people, your HR, your supply chain or procurement processes. So thinking about functional heads, as well as having that board of advisors structure to help you think through the bigger picture and to advise you accordingly.
So, Madren, when it comes to scaling, is the timing important? And if so, how important is it? And when should I scale?
Yes, that's an interesting one because it depends. It depends on the organization. It depends on the market readiness for you to scale, because we have seen organizations that scale and then collapse because there isn't enough demand in the market for your product.
Yeah.
So I can't give you a specific timeline on, when you get to year 3, year 5, now scale. You have to look at asking whether your services, your products are required, whether there's enough demand in the market. Where is that demand? Is it within the current location? Because scale can mean many things to different people. It could be that you're now thinking about expanding to a different city, a different town, even particularly even to a different region or country. So scaling can be defined in different ways, but essentially you need to make sure that you are able to continue to provide services that are required. Is there a market? Is there this demand for that?
Yeah.
And can you produce it in a manner that is cost effective to reach that level of scaling?
Are you saying I shouldn't just scale because capital is in? I shouldn't just scale because my profits are coming in?
Profits are great, but what you want to see is cash.
Mm-hmm.
Yeah, you want to make sure that you have a steady stream of cash, because then that will help you to shore up, especially when you're scaling. There are times that you might find it's not automatically that you will continue to make cash. You might need to make a bit of investment for that scaling up. You're buying new furniture, new CapEx equipment. So you're investing as you scale up, and you need to be able to have the cash in place. So profits are a good indicator. They do indicate that there is a sustainable and viable business idea that has been worked on. There's a model that is working, and it definitely gives you a green flag in terms of to consider scaling up, but also be mindful of the fact that you need cash to scale, you need markets, and also you need to have the right structures in place so that you're able to maintain the same standards of service and expectations are met in terms of your clients and your customers.
All right, and in relation to scaling, Madrin, one of the things that normally a lot of SMEs struggle with is at what point should I get credit? At what point? And I know this is something that you had touched on earlier on when we were asking whether having a board will have an effect in terms of how I'm priced as a customer or as a client. So the question that then comes to mind is, in relation to that, at what point do I need to go to the market and say, I want to raise X amount to either scale the business or to plow back into my operations or to make my operations more efficient?
Right. So you need to look at what is your annual business plan and your strategy, and then compare that vis-a-vis what assets you have, and that can include things like your cash or your collateral that you have. And if you find that there's a gap, you have an ambition, you have a plan, but there's a gap in terms of financing, then you can approach lenders in the market to assist you with that. And that can take the various forms. It could be that perhaps you're looking for a credit guarantee. It could be that you have short-term needs and so you need an overdraft facility. Perhaps it's a long-term loan that you need to buy, capital expenditure equipment, plant and equipment, or even to buy office space. So depending on what the strategic plan is, that will help to inform when you approach financiers if there's a gap in terms of your resources.
All right, so Madrin, part of our conversation this morning was looking at how do we then protect our profits. In your experience, and I know you deal with a lot of businesses, what do you see as the best practice in ensuring that the profits that we make as a business then goes into the right use? It ensures we have enough capital buffers to take us through, let's say, a pandemic. What we saw with COVID, because COVID hits, and a lot of businesses shut down. So how do we make sure that whether there's a pandemic, whether there's volatility that we are seeing in the market, either locally, whether it's our supply chains that are being disrupted, what are some of the things that we need to do with this capital, with these profits, to ensure that we protect them and to ensure that they sustain us in the long run?
It's important for business owners and SMEs particularly to think about how much of that profit and that cash that is available is going to be reinvested back in the business and how much of it is going to be taken out. So thinking about a dividend, if you're a business owner and you want to pay the business, the shareholders a dividend, how much dividend, and having clarity, are you going to pay out 75, 80% and then retain 20% in the business for continued growth? So those are the things that one needs to think about as they are putting together their strategic plan. Don't take out everything, because a lot of times we make money at the end of the year and we pay ourselves, and then the following year you find that the company might then be starting from ground zero, and there's not enough reserves to be able to help it continue running. So it's a fine balance. Look at your cycles, your business cycles, and determine at what point do you then take out that profit and how much, and have a policy around it so that it safeguards the organization. Even if you're not there, that people who are working for you know that this is the maximum that we can take out and the rest must be recapitalized or put back into business operations.
So, Madrin, beyond just having good governance in place, beyond having good profits coming in annually, what more do I need to do as a business owner to ensure that my business is attracting the right kind of funds that and the right kind of investors who would want to come into the business?
I would suggest that you think about, as a business owner, as an SME owner, or working within an SME, think about separation of roles. That would make a big difference in terms of how viable and how attractive you are. The ability for people to see that, Madrin is not the founder, the manager, the owner. She's wearing so many different hats. That is a risk. It's a key man risk for the organization. Sole proprietorships, if you think about companies that have been registered as sole proprietorships, clients feel hesitant dealing with them because I could pay you a lot of money today to deliver a service or a good, and then tomorrow you're not there. How do I get my money? How do I get the value? Because you have gone. And as a sole proprietor, that kind of structure is very is a bit one to think about. Might not be viable for the long term. So setting yourself up in terms of a registered company with a professional management team, and it doesn't need to be a very heavy management team. Just think about where are you in terms of your growth. What do you really need for that year, and then you scale up as you go along. And then as you go along, think also of advisors, a board of advisors. So separation of roles is very important. It also helps the founder and the business owner to not get fatigued, not become a hindrance to the organization, and not control it to the point where it dies. The other thing to think about is, accuracy and keeping of books and having key performance indicators that can tell you whether or not your business is actually profitable. Sometimes we wake up in the morning, you go to work, you do your thing, come back, but are you really making money? Are you able to demonstrate that actually you're on track? So having dashboards that help you keep track of what it is you're doing is important. And then thinking about risk registers. Because as you do what you're doing, running your business, things happen. Things do happen, things that maybe you have not foreseen or you have foreseen but forgotten to mitigate. So thinking about insurance and saying, you know what, I'm going to pitch for this business. There's a particular risk in dealing with this sort of client, but I'm going to manage it in this way. So those would be essentially some things to think about as you're thinking of scaling and growing and protecting your growth.
All right, so Madrin, just before we continue this conversation, it's a good thing that we're talking about raising capital and we're talking about capital-related solution. And to you who's following this conversation, allow me to remind you that if you come to GT Bank, we are at GT Bank, and we have some of those solutions, particularly if you're looking for a loan, you can get up to 13.99% annually. And of course, this is based on your salary largely, so you can feel free to reach out to us and we'll be giving you more details. Remember that the usual terms and conditions apply. If you're also a Malkia account holder, there is 15% discount that is currently going on, where if you go to Radisson, particularly Radisson Arboretum, we have a partnership with them, and you'll be getting about 15% discount. But another solution that is quite interesting, if you're doing transactions on PesaLink, for any transaction that is less than 1,000 shillings, the cost, that is purely cost-free. There are no charges for any transactions that you do on PesaLink of up to 1,000 shillings. Anything between 1,000 shillings to 1 million shillings on PesaLink, you will be paying only 20 shillings. Imagine that, for that kind of transaction, and you only have to pay about 20 shillings on PesaLink. These are some of the solutions that we will definitely be providing more details to you. If you need to get in touch with anyone from the bank, kindly reach out to us on our social media platforms, of course, through our particular segments. We have gloria.nalimu@gtbank.com. You can reach out to her. And also we have, for SMEs particularly, we have maimuna.hassan@gtbank.com. I will repeat that, maimuna.hassan@gtbank.com. If you have an SME related question, if you have an SME related issue that you need to be addressed, that is the person that you need to talk to. Just write to her and she will be responding to some of those concerns as and when we get them. So, Madrin, let me come back to you. And in relation to what we're talking about, particularly around capital, and the question that a lot of us struggle with, and anyone who's been in business struggles with, is all capital good capital? Just because it's on the table, is it good for the business?
Capital is always good to think about. Mm-hmm. Whether you take it up depends on what your needs are. And you need to be very crystal clear around where that capital will be deployed. Otherwise, it is likely to be taken up and then misused or misdirected. And then that can create an issue because you still have a repayment that you have to take account of. So is all capital good?
Yeah.
You need to think about the conditions that accompany that capital and clarify what is expected of you, what the lender is expecting. You mentioned the interest rates there with some of the facilities.
Yeah.
You need to look at that and say, within my business, can I sustain that level of interest payment? And what do I gain in return for that? Does it unlock new business opportunities and growth for my business? So you look at capital vis-a-vis what it is you're requiring that capital for, and ensuring that you're able to also pay back and meet the conditions of that come attached with that capital.
Also, Madrid, when we started this conversation, something that you talked about, and I consider this one of the biggest risks to business, is having the wrong people in your organization. And besides that risk, let's talk about the management side risk that comes to the business based on the people that you have running the company. What do you think, or what have you seen as being one of the costly mistakes that a business would make, particularly when it comes to their management?
If you do the wrong hire, is a big one. So if you bring in someone who is not competent, not capable, but more importantly, does not have the right values for your business, is not aligned, then it is likely to be very expensive and a big mistake. So you have to invest in the recruitment process. Don't necessarily rush it. Don't pick people who are, have been sent to you, because this is, where we operate. We have a lot of relatives. We have friends who will say, take my child, please give them a job.
Yeah.
It's great to have those, those sort of offerings, but take them through a process that is credible, and so that they come in on merit. They have passed through a recruitment process, they have competed for the opportunities, and they come in on merit. And that's particularly key for senior management and management roles, because they are the ones who set the direction, set the tone, and they role model the behavior that other team members will also be expected to adhere to. I think it's Warren Buffett who said, when you're hiring someone, there are three things that he looks for: intelligence and intellect, energy, or passion, as well as integrity. And if someone has the first two, intelligence and energy, but doesn't have integrity, room for disaster and chaos. So very, very important for you as a business owner to be clear what is your value system? What is acceptable behavior and conduct in your organization? And follow through on that. If someone breaches that, is there, any reprimand? Is there anything that is done about it, or do you just turn a blind eye?
Yeah.
So as you're thinking about people and senior management, setting that tone, and also thinking about succession. So because people are here for a season, your manager might serve with you for a season. Are you providing room for them to grow within the organization? Their career paths, can they move to different roles and extend their skills so that they become transferable skills that can be deployed across the organization? And beyond that, as they are moving, who is coming behind them? Are you growing talent? Are you growing young people to take up those opportunities and lead for the future?
Okay, and it's quite interesting that you bring up that quote from Warren, because in relation to integrity, there's a question of tax compliance. I mean, when we operate in the economy that we operate in, tax has become one of the biggest headaches for companies and for businesses. So why is it important for an SME or for any business to be tax compliant? And does it have any benefits to the operations of the business in the long run?
Right. Being tax compliant it's a given. It's important that as a business owner, you're aware of the tax obligations and that you follow through and comply. Pay us to Caesar, we want services from government, and so therefore we need to do our bit in terms of paying for those services. The question of whether that money is well utilized is a separate conversation, but for us as business owners, as managers, the law is the law, and what you need to do is to determine for your organization which are the applicable tax regimes, get the relevant advice so that you're paying the right taxes at the right level and not overpaying, and so that you're able then to be able to demonstrate that you are a compliant corporate within our society.
Okay.
Yeah.
All right. So back to the questions that are coming in from our audience. We have Joyce Githinji who's asking, as a person who has been running a business alone for years, as the owner, shareholder, and management, how do I begin the governance process gradually without feeling overwhelmed?
Yeah. One is to first take a look at yourself. I think for me, that's what I usually would suggest. Becoming self-aware about what are your strengths and where are your areas of development, because we are not perfect in all spheres. So if you know that actually I'm great at strategic things, I'm great at going out to look for business, that means then you might need to have someone who is sitting in the office, or if it's your home office, doing the day-to-day running of the organization. And that will then determine that you need a second hand at that level, at a management level. I need a manager or someone to support you, do the day-to-day. So self-awareness and then understanding where you need help is very important. And I would say thinking through having a management team is your first step in helping yourself to then separate and to also get out of wearing all three hats at once. And then thereafter, then bringing in these independent advisors or board members as the organization grows and matures over time. Yeah.
All right, so Joyce, there you have it. The key is just separation, start it gradually, and then you will be able to continue. Now, I just want to see from the team whether we have any questions that are coming in from our online audience, particularly those that are on Zoom, and we'll be getting back to a number of those questions as we continue with this conversation. So just keep them coming. We will be sampling some of them as we continue in this conversation, and I can see that our time is very fast running out, but don't worry, send in all the questions that you have, and we'll be sampling them in a couple of minutes. So, Madrid, let's come back to a question in relation to what Joyce has asked. That separation. Do I start with setting up the board? Do I start with identifying people that can sit in my board? Do I start looking at the cost of having a board? How do I make that decision so that even before I embark on that process, I know exactly what I'm starting with?
Okay, so for me, what I would suggest is first have a team around you that helps you with the day-to-day, the management team. And that could be, someone who supports you with the running of the numbers, the finances. So once you've structured the management, then you can then look up and say, okay, I need these advisors to help me. And what I would suggest is have a clear, like the way you're recruiting an employee, you have a job description. So have a clear profile of who you want to be part of your advisory team or your board. What are the skills that would be required given what it is you're trying to achieve? Are there markets where you're not able to enter, you're not able to access, but this person, this advisor might be able to open doors for you? So clarify what it is you're looking for in this advisor so that now as you're looking in your network, as you're asking professional associations, as you're trying to identify these individuals, you have a checklist of things that they must be able to demonstrate, and that keeps you true. It keeps you focused, and it helps you to build in objectivity as you identify these people.
All right, so what we tend to see, Madrin, particularly in our Kenyan setup, is a lot of hybrid, where you'll have a number of management staff who also sit on the board, or a number of board members who sit in management. So the question that I want you to help me understand, is there a risk in that? And if so, what is the risk?
It is quite common to see we call them executive directors.
CSOs,
yeah. So they are in the day-to-day business, running of the organization, but they also sit on the board, or some of them attend board meetings, present, and then they leave. But then there are those who are appointed as legal directors on the board. Now, there's nothing wrong with that. What you need to make sure is that in that boardroom, there are other voices that can be able to counter-check, to ask the right questions, and validate what the executive director is saying, and then provide direction and decision to help that executive director go back and then run and effect those decisions. So it is okay to have people who are managers also sitting on the board. Try and have other members in that boardroom, other players in that boardroom, or advisors who are not part of the management team, so that they bring in that level of independence and check and balance.
All right, so let's talk about the cash and the cash flow in the business, Madrin. What percentage of my cash flow should I hold in cash? How much of it should be in liquid for my business, so that I ensure there's this continuity and that the business continues to be sustainable? How should I make that divide in terms of ensuring that you're liquid enough on one hand, but you also have the assets that you need on the other?
Okay. It's very much like how you would run your own personal finances.
Yeah.
And we keep saying that, when you get your salary at the end of the month, you have certain expenses that are a given. You have to pay rent, you have to buy food, you have to pay tithe. So those things must be taken care of. And therefore, if you can compute that need for your company on a monthly basis and say, maybe this month I have to pay tax, I have to pay rent, for my office, I have to pay my staff, that will form the liquidity need that you need to generate, to cover those costs. Should you have more than that, then that is surplus, which you can then be able to reinvest, to save, to put away. NGT Bank and other financiers have facilities and products and services where you can be able to invest, and it earns you some interest while you're busy growing the business. So it's very much dependent. It depends on the size of the company and the nature of expense levels that are in the company to determine the liquidity. As much as possible, you want to be able to match your assets to your liabilities. So, for example, if every month you need about 3 million shillings to keep your organization running, if you can make sure that you have enough cash to take care of that and a bit more, 1.5 would be great, or even higher. That would be great, so that you're not straining the company and ensuring that you have enough buffer and surplus to take care of those rainy days. There are times when the month is very slow and there are no customers, there's no revenue coming in, then you can tap into those reserves that you have put aside.
All right, and still on finances, particularly financial transparency. How do I ensure that I don't necessarily expose my competitive vulnerabilities by being financially transparent. And who do I need to be transparent to?
So there are certain stakeholders who are very interested in your numbers and in your financial performance. For example, the owners of the business, and they need to know how are you doing. They need to see the numbers, make sure they are accurate, they are reliable for them to make decisions. So stakeholders such as your owners, stakeholders such as any lenders that you might have, you need to be able to demonstrate and show those financials to them. There might be certain members of your team internally who also need to see the numbers, because that will then tell them whether or not they are generating any value for the business. So it's important also within the organization to have management or team sessions where you can share high level how the business performance is looking like in terms of the numbers, and then that can help you then to ensure that the targets are well aligned and that you're actually delivering value for the organization.
All right, and I know we had touched on this a bit earlier on in this conversation, and this is just when you're thinking of scaling, and again, something that a lot of entrepreneurs and business owners struggle with is that debate between equity or debt, and which is the best option for me to raise capital or for me to raise enough money just to be able either to scale or to make the business more efficient. So what would you recommend, and what do I need to consider to determine whether I should go the capital way or whether I should go the debt way or I should go the equity way?
Okay. Your starting point again would be, what is your strategy? Where are you trying to go? And therefore, how do you fund that vision and that ambition? Debt essentially is, going to get a loan or financing and then having to pay that back. Equity means that individual will be coming into the organization, probably getting shareholding, and is more long-term in nature. And so you need to determine which option would work best depending on your strategic goals and ambition. So that's how I would put it. It's guided by your strategic vision. But both players are available in the market. You will find that there are capital venture firms that are willing to put in money. Private equity ventures also are available, and so they have money and they will want to structure it in a certain way. And for you, you need to determine whether or not that is acceptable given where it is you're trying to go, and also what are the conditions for how long. Is it patient capital, or do they need money to, they need you to deliver certain performance indicators and then get their money out? What is the interest rate for, debt? Is it viable and sustainable? So there are a number of questions that one needs to test to be able to determine which is the right model, whether it's debt or it's equity.
Should market conditions also inform that decision?
Market conditions can help, because then they can tell you whether or not the macroeconomic indicators are supportive of you taking on this additional debt or this additional loan. So that is an important part of your analysis, to look at your market conditions, ensure that the market is still there to enable you to be able to sustain the promise that you're making to these investors, whether debt or equity investors.
All right, just remind our audience that even as we continue with this, if you're looking for an investment opportunity, if you're looking for an investment option, we also have GT Mazao account, which is an interest-bearing current account for SMEs, and there you will be will also just helping you in terms of, as opposed to having your capital sitting in the bank, you can also have it in that current account and also earn something as you continue to wait and to determine where you're going to put this capital in. As we're coming to towards the end of this conversation, Madrin, and the one thing that I know a lot of us will make the mistake of is that mix-up of the business account is my personal account. Why is that a risk? And I know we talk about it in our informal setups, and we say why you need to separate the business account from your personal account. That mix-up, there's the prestige of, I'm a sole proprietor. If I go to the bank, they'll be looking at Jimmy, who Jimmy is the institution that runs,
Yes.
let's say, Jimmy Enterprises.
Yes.
All right. So, but if I separate Jimmy Enterprises from Jimmy, then one of us does not have the capital backing that I might need to prove to GT Bank or any other financial institution that I'm a credit-worthy client. So that talk to us about that separation and that and that very gray line in between.
Yeah, and it's a common practice, especially as you start up business. You mix your own personal monies with what is generated by the company. And as you say, as a sole proprietor, you find that you open one account and you either tap into it for your personal expenses, pay school fees, pay the rent, but also you're using that same account to be able to meet your other business expenses. The separation is important because you need to be able to determine that this business as a separate legal entity, because we are encouraging our audience to register their organizations, as a separate legal entity, does it have legs? Can it sustain itself? Is it a viable entity? And also think about liabilities, because when you mix personal and business, in the event that there is an action taken against you, there is a legal claim that is made against the company, then it could apply to you if that liability is not separated. So it is important for business owners to think about setting and registering a different entity, a legal entity like a private company limited by shares, or an LLP to run their business operations and allow that organization to demonstrate that it is actually viable. It has money coming in, it has its own business expenses, it pays taxes, and liability then is limited to that entity. They cannot reach out and touch Jimmy and say, Jimmy, I'm coming for your house because you defaulted on a loan for Jimmy Enterprises.
So it also cushions you whenever there is that liability that you're struggling to meet.
Yes. So there is a risk that you're mitigating by separating and putting in place a formal corporate structure for your business. And we have professional advisors that can help you to structure your business in a manner that makes sense and is also future-proof. So, for example, with my firm, we can help you to think through what is the best registration structure, whether you set it up as a company limited by shares, one limited by guarantee, because there are those corporates that are there for social impact. They are not really wanting to make a profit. There are those entities or organizations that want to set up as an NGO. So we can help you think through those structures and see what best suits you, and also thinking through the tax environment and how, therefore, to protect what it is you're gaining as a wealth builder.
All right. And when you talk about registering the business, even as you're just speaking, something came to mind. So I opened a business, for instance. I opened a business to do production, but somewhere along the way, I also want to expand my risk. I want to sort of scale and maybe move from production as the main as my sole business and move into, let's say, imports. So how can you help me ensure that, do I need to register a different business, or what do I need to do with my current business to ensure that even as I expand my mandate, I am not putting myself at risk?
Okay, so we go back again to what was the original vision
of the business.
The business, and when the founder was setting it up, what did he have in mind? Opportunities do come along the way, and you might see there's a need for a particular product, and maybe, as you're saying, you want now to export and not just manufacture, and you can accommodate that within your existing business as long as you have the structures to support it. You need to think about import, export taxes. You need to think about supply chain. How do you move your products out of the country? How do you get your raw materials in? So it's not just the what you started off with. You are expanding your products and your services, and that can be accommodated within the existing structure that you have. However, there are people who would say that they want to separate the two for a number of reasons. Perhaps they don't know for sure if this new business venture will have legs. It might or might not work. And so to avoid compromising the main business, the core business, they set up a separate legal entity and run it through that other legal entity, so that it then is able to stabilize and then can form part of a holding company or a group company structure. There are tax advantages as well that one can look at in terms of how you do your structuring of your different business entities. But for most entrepreneurs, what you will find is that there's always an opportunity that they're trying to look for, they're spotting, they're chasing after.
Yeah.
And so there's nothing wrong in expanding your level of services and business products. It is important that you keep opening yourself up. But remember, why was this organization created?
Created in the first place.
And remember to stay true to your governance documents, because those are what is registered at the Companies Act. There's a document called the Memorandum and Articles of Association, and in that memorandum, it says the objects, the reason, what type of business enterprise, business ventures you can undertake. Typically, lawyers, legal professional advisors, and company secretaries like ourselves would make that mandate very wide, because we know business owners and entrepreneurs will be trying different things. And so just make sure that it is not a closed-off activity as far as your governance documents are concerned.
All right, so Madrin, as your closing remarks, you can give us your closing remarks, but at the same time, I want you to talk to us about the mistakes that we should avoid as business owners and as entrepreneurs.
Right. So for me, my main message here is that governance can unlock for you sustainable growth. It is the key to thinking long term. As a business owner, most times we're in a stage where it is me, the business owner, the founder, who is approving everything. Everything goes by me. There's no rhythm. There's sometimes surprises. I come into the organization, I take money. Tomorrow I'm asking for more money. So those sort of cash surprises, the lack of stability and consistency and rhythm is mitigated by putting in place governance structures. So you want to move into a space where you're separating roles and being very clear who is accountable, who is the decision maker. You also want to be having dashboards in the organization that can help you to track performance, financial performance, and other types of performance, and that you're managing your risks through a risk register. So at the end of the day, what that will do for you is that you will have faster decision making, because there's clarity on who does what, and the founder is not blocking, is not acting as a, creating a bottleneck. It will also help you to reduce your risk and therefore protect your profit. And from that position, once you have your governance in place, your structures are in place, you can then approach funders, capital, funders who have money, who want to invest. They can look at you and say, yes, this is a business that we feel has a future. There's clarity, there's transparency. The money we put in, we are sure we will get back. It won't just go to waste or disappear.
All right.
So governance unlocks growth and sustainable growth.
All right, and for the sake of our audience who are following this conversation, where can they find you if someone wants to engage with you even more at a more personal level, if they want specific tailor-made advice for them, where can they find you?
We're available. Our offices are at AdLife Plaza, 4th floor at Kilimani. The firm is called Azali Certified Public Secretaries, Azali CPS. You can reach us also on email at admin@azali.co.ke. admin@azali.co.ke. We're also available on phone. The phone number is 0707 456, my apologies, 456-140. Let me repeat that, 0707 456-140. And you're always welcome to engage with us, and we're more than happy to help our clients.
All right, thank you very much, Madrin. That has been Madrin Oluwat, who is the managing partner at Azali. And of course, she's just shared with you all her details in terms of where you can find her. And if you're looking at financial solutions, just like to remind you that you can come to GT Bank Kenya, where we have GT Malkia account giving you a 15% discount at at Radisson Blue, particularly Radisson Arboretum. If you're looking for a personal loan solution, we're giving you as little as 13.99% per annum, and of course just the usual terms and conditions will apply. But for those in SME space and you're looking to make either a payment, you want to send money, or you want to make a transaction, we're just reminding you that for any amount between or less than 1,000 shillings, it is absolutely free. And for any amount between 1,000 shillings and 1 million shillings, you'll only be paying 20 shillings. Imagine that. 20 shillings. That is lower than what is currently out there in the market as an option. Again, to remind you, if you're looking for a personal loan, we're offering you that at 13.99% per annum. And of course, we also have the GT Mazao account, which is an interest-bearing current account for SMEs. So if you're looking for an account to hold your cash to ensure that, or to have a business account, I think this would be a wonderful solution for you to consider. Thank you for watching. That's all the time we have for you on this webinar. Of course, we look forward to engaging you in the coming days as and when we have that opportunity. We have shared with you also the emails where you can reach us. We have Gloria Nalimu at gtbank.com and Maimuna Hassan at gtbank.com. If you have any concern, any banking issues, or any challenges that you're currently facing, those are the accounts that you need to reach out to, and they will be giving you the solutions. They will be directing you to the right people and making sure that that you're banking with ease, because at the end of the day, we want to make banking as convenient as possible for you. Thank you for your time. My name is Jimmy Mbogo. See you at the next one.